It is time for you to increase your prices or your business will struggle. On today's episode of The Stuff Your Accountant Isn't Telling You, we're going to talk about why that is the case. We're going to talk about what you can do about it and go through some step-by-step things that you can do to help you successfully increase your prices and stick around, because for the tax tea today, we're going to talk about a man found guilty for a fraud involving auto warranties and how that could impact you. So stay tuned. So welcome back to the show. Now, today is a great show because today we're talking about pricing. And I will be honest, I am not one that is been the greatest when it comes down to increasing prices.
That is correct.
Now, for a lot of people, I think that they struggle with this when it comes to them increasing prices. But at the same time, we don't have an issue when other people are increasing their prices. For example, if you have a subscription, let's say you have a Netflix, a Hulu, a Amazon Prime, like those prices for the most part have been changing, whether it's year over year or every 2 years. Like those prices are not the same, and we don't have a problem paying them. Like we may complain about it, but we still pay it.
That's true. It's funny because I was looking at our bank statement a couple of weeks ago, and I saw the Netflix bill was like $18, and I'm like, when did we get to $17.99? But it wasn't even something that phased me. I was like, oh well, hey, it was $9.99 or however long however long it was before, where it was $10. And now it's like, okay, they've increased the prices, to $18. It's still reasonable for me. So to your point, I do agree. I think sometimes when it comes to paying prices, we may complain about it. But if we're getting some sort of value from it, it's like, okay, you absorb the shock of it and then you just move on.
Absolutely. Absolutely. And I think that a lot of service-based businesses and product-based businesses, like I said, all small businesses in general, I think they really struggle with this. And I think they have a lot of apprehension to changing prices. Some of them like, I don't want to upset my customers. Right. I don't want them to leave. Right. And it's just like all these different things. But it's just like, if we look at the industry, one of the things that we see across the board, people are willing to absorb higher prices. Now, yes, there are some that are really sensitive to pricing, right? Where if their pricing goes up, they're just like, okay, I'm leaving. And which, in my personal opinion, if you have some clients that are that price sensitive, and let's say you go up 5%, 10%, let's say you go up an incremental amount. If that changes the game for them, I would probably say is you have to ask yourself, is that a client you really want? Like, is that the right client for you?
Yeah, that's a good point. I think for me, for everyone that is a business owner, most people have worked in some sort of job where they were employed at some point. And one of the things that I always tell people is when you're looking at it, look at it for you personally. If you are working somewhere and you were delivering and you were putting in work, would you rather have an employee that is happy with what they're making and what's being paid, and then you can hold them accountable to what they need to deliver? Or would you rather work with an employee that is unhappy because they're not being paid, and as a result of not being paid what they want or increasing, their pay ask, then they're delivering poor work? And so I think it goes the same way as a business owner. Is if you think about it, is you want to be able to deliver the best value to clients, and raising prices is important to be able to do that, especially now in this inflation period. Like things are going up. So if you're not increasing your prices, especially if you're selling products, like you're having to absorb that cost, and it's not sustainable for your business. So I think that while people may be reluctant to do it, to the point that you've made, where if you're losing a client because they are so price sensitive, it might not be the best person for you to work with. Now, it's a different thing if, the increase is substantial to where they're like, my business just can't afford it. But if it's more of like the statement where it's like, your price going up 10%, I don't want to pay for this, I'm leaving. It's like, all right, then maybe you do need to leave. And I think you're going to always have that. You're always going to have people that you lose. It's just like, if I think back to the personal and employee situation, is would you want a manager when you're like, hey, I need a bonus of 10% or an increase of 10%? All right, well, I think you just need to go work somewhere else. It's like, is it really worth losing the value that you're getting from this person because you don't want to pay the increase? Same question. If you are working with customers who value and truly value the product and the, you know, the service that you're providing, for them, the question will be, is it worth losing the value and the product or service that I'm getting from this person? Or do I just absorb the price increase? So, you know, these questions are going through people's minds. So it's not as, I think it's clear cut. And I think some business owners are concerned. I mean, even with us, it's just, we've gone through that, right? Of if I increase my prices, are people going to leave? The reality is there's going to be some people that leave, and you just need to be okay with that. That's like the first baseline, I think. Yeah.
Yeah. I mean, and I think there are some very effective ways to address that, which I guess is a whole nother conversation, I think, about the value you're delivering versus the price you're charging. In which we'll probably do another episode on that, because I think when you're talking about pricing, that is a factor in it.
Yep.
But I'll briefly mention, I do think is, like you mentioned with the value, because, you know, we see prices go up, whether it's on your utilities, prices go up. When it comes down to property taxes, prices go up. When it comes down to fuel, gasoline, prices go up. When it comes down to even, you know, pure luxury things like Netflix.
Right.
For most people, Netflix is not like an essential expense.
Right.
I mean, it is a luxury entertainment expense. Price of that goes up, or whether it's Disney Plus, or whether it's, you know, your cable, your internet, like different prices are going up in so many different areas. So it's not like people can say, well, I only pay higher prices on the essential things. I'm like, you're probably paying higher prices on, you know, those, I guess you say, recreational things as well. So I do think it does come down to that value perspective. And I would say is, because I often tell businesses that are on the fence or they're struggling about whether or not they should increase their prices, and I always tell them is, let's just purely look at this from a math scenario. Your employees are expecting what type of raise year over year? And say if they're expecting anywhere from 2 to 5%. And with inflation hitting now at 7.7% in the US, they might be expecting to have another cost of living
inflation
increase.
Adjustment. Right.
So if they get a cost of living increase, but your prices don't change, only thing that just happened is your business is going to make less money because your cost just went up and your pricing stayed the same. Now, the only way you resolve that is if you can sell more volume. But we know that if the cost of everything is going up, people tend to buy less as a whole. So it's just like the math just tells me your cost is going up because you want to pay your people more. Or let's say, you know, you want to be more environmentally friendly and you want to use, whether it's more renewable energy, or you want to use more eco-friendly products. Well, oftentimes that comes with a cost. Like there have been some places where they wanted to use paper products that are more recyclable than the standard or whatever. Well, it's like that may come at a little bit more of a cost. Like it's great that you're being eco-friendly and environmental friendly, but your decision to do that raised your cost and your prices are staying the same. The only thing that's going to happen is your margins are going to get tighter and tighter. And that's not a comfortable place to be in any business.
Yeah, and eventually you get to a point where then it's costing you, you're putting more money into the business than you're actually getting out. And you have to, I mean, plainly putting it and just being very direct, like for your business to survive, you have to have some sort of margin, right? And you need to make money. You need to make money. So prices are important. I mean, I think that's just clear cut. And I think one of the things that we wanted to spend some time today on talking about is just practical ways of, hey, this is how you go about doing it. Because I think sometimes we're like, man, like, okay, fine. I know I need to increase prices, but where do I start? Like, what do I do first? Right. To make sure that I'm even doing the right price increase. So do you just want to kind of go down that list? I would say, I think based on what we talked about, the first and I guess the biggest and important thing is, which is what I alluded to, is just even understanding how much price increase should you be doing? I think inflation is a little bit more of, well, before that, I take that back. Before even understanding how much of a price increase you should be doing, the first thing that I would say you need to do is look at your top selling products. Like, what does your portfolio look like? Your top selling products, your top selling services. And once you look at that, I think that kind of gives and sheds some more light. So what would you say are kind of some of the things that you would look at if we're just looking at the portfolio, what are some of the things you need to pay attention to?
Yeah, I mean, I agree with you. I mean, I think when you, even to get down to what your top selling products are, it's just pull a sales by product type or sales by service type if you're a service oriented business. Like, for example, like we do, you know, bookkeeping and CFO services, and then we also create courses. So it's like, okay, all right, how much revenue have each of those channels generated? Because I think it starts to help you understand, like, okay, all right, where is our money coming from? Like, what are our top sellers? Because then you can really say, okay, all right, maybe what if we don't do a, you know, a 5% price increase across the board? What if we only do a price increase on certain things strategically? Like we look at, hey, what are our top 10 sellers?
Yeah.
Because, or what are our top 2 sellers, however many products you have, because those are the things that your customers are telling you. We really want this. Out of all the stuff that you do, this is the thing we want the most, which probably tells me there is some flexibility on those items to where if you increased it, there's enough of a demand for it that people would still be interested in.
Yeah, that's really good. I think when it comes to also looking at the demand or just the top sellers, I think another aspect, which is interesting, I was listening to a commercial leader talk about this, I think a couple of days ago. And one of the things that he actually recommended, as much as you're looking at what your top selling products are, is to also look at your bottom 20%. So what's not selling as well? Because I think in addition to also looking at what's selling and then running that sales by product, is when you do the gross margin analysis on each of those products, you might have something that is taking you a lot of effort and a lot of money to create, but is not really selling that well. Yeah. And in those cases, if you're putting money into it, but you're not really getting as much revenue, it may be a good time to eliminate that product. And actually, one of the things that he was recommending, which I initially I was like, why would you do that? But it made so much sense. He was like, actually, on the products that are not selling that great or where you have very, very low margins, it's probably a good idea to either increase the prices on those, because what it does then is it forces people to start to look at some of the other products that you might have. Like, let's say they like you, or there's a service that you offer where you're like, hey, we're discontinuing this product or we're increasing prices on this product, but here are other products that we offer in our portfolio that still service or do what you do, and or do what you need done. And those products or services may fulfill what they need, but have higher margin for you. So that's another thing to consider, is as much as you're also looking at, hey, what are my top sellers? It might be a good idea to also look at your bottom sellers, because in some cases, if you're putting a lot of effort into creating a product or a service, but you're not really making money from it, and it's a low margin product, it may be a good idea to increase that price so you can basically push people to get a better, more profitable product that you're already selling.
Yeah. And I think that there's a lot of ways that you can approach like that pricing. They call it like pricing psychology, pricing sales psychology. I think there's some great ways to approach that, which, you know, we talk a lot about in the small business CFO program. We go in a lot more depth because there are layers to that, because I've seen and helped some companies that they had some compatible products. People normally buy this one, but they also had this one that was comparable. Yeah. And we came up with a strategy of, hey, raise the price on this one. When the price was raised, people were like, hey, I don't know if I really like that as much. Well, we have this product over here that does very similar thing. And then what a lot of people started doing is they started buying the other product, which allowed them to take advantage of, like, you know, economies of scale, and they were able to increase their profitability. So no, I think that's a really good point. Now I will say is, because like I said, we won't go into all of the details of that strategy because it is a strategy, but I do think, you know, you bring up a good point. It's after you get that list of, okay, what are all my products or services? What are they selling for? Then I think a competitive analysis will be great, is looking at what are your competitors doing? Oh yeah, that's good. Of like, because you're not the only one selling this product. I know. I talk to small business owners all the time. Like, you're not as unique as you think you are.
My product is unique. No one else sells what I sell. No one offers. My services are unique. Yeah.
And but I do think, because, you know, I think you run into that issue of, like, from a marketing standpoint, you know, you want to advertise how unique you are. But I think when it comes down to your product, and they may not be selling your very specific product.
Yeah.
They may be, and that's where I think you have to think of it from a standpoint of what problem is my product or service solving? And then when you start to look at a broader scale, it's like, okay, all right, what other things also solve that problem? Like, for example, when it comes down to an accounting firm, when it comes down to, bookkeeping, people may say your direct competitor would be other bookkeepers. But in some senses, for some people, bookkeeping is just, it helps you get ready to file your tax return.
Right.
And so what some people have looked at and said, well, hey, I can use the Mint app or whatever, which helps me track my expenses. And, if you understand bookkeeping, you will know that's very different from bookkeeping.
Exactly.
But in the mind of that customer, their mindset is, well, the Mint app does the same thing you do. So in the customer's mind, these are bookkeeping and this Mint app, they are competitors, although we know it's different. So I do think you have to not just think directly, who are my direct competitors, but what are the other potential competitors that my customers could be looking at? And then ask yourself, what are my competitors charging for the solution that they're offering?
Right.
Because the customers are comparing your price to other alternatives.
Right. What else
and that's what they're kind of using as like a baseline to say, hey, how much should I pay for your services or for your product?
Yeah, no, that's good. I think just practically speaking, going back to the example, I think we use one of the things that I recently discovered was the Facebook ads. Like the example that you gave for, like Mint versus like what's Mint putting out there? How are they phrasing things? What kind of ads, what active ads do they currently have going? How can you modify what you're putting out there to make sure that, hey, it aligns? But the point is, for specifically for pricing, is just looking to see how are they pricing, what are they pricing, what are you offering? So I think the point that you made about just understanding how your customer views things versus how you view things, because as a business owner, you're thinking, well, Mint isn't a competitor for me, but to the business, to the customer that you're looking for, going back to bookkeeping as an example, to the customer that you're looking for as a bookkeeper, like they see Mint as an equivalent. So you need to learn how to look at things and interpret things from your customer's point of view. Is when they're comparing you to another company, who are they looking at and how are they baselining that? And I think once you understand that and what charges are they, what are they pricing, then I think you kind of have a baseline. And then from there, you can kind of go on to the next thing, which would be, okay, now we understand what our top products are. We understand what products we want to increase prices on. Then secondly, we understand, hey, what are our competitors doing? How are they pricing their stuff? And a lot of that stuff you can find on Google. Like Terrell, you said, nobody's business is unique. Yet to find a unique business. And then I think the third thing is just going through the process of increasing prices. And like all these strategies, like one of the things that we've talked about strategies, and we don't have to dive too much into it, but one of the strategies we talked about on pricing, like specifically for the small business CFO group, was just when it comes to how you're navigating existing customers. Because like one of the things that we said was for existing customers, they're like, okay, prices are going up X%. And one of the strategies that we gave is, well, you can still increase prices, by let's say 10, 15, I don't know, 5%. Let's say 5%, you're increasing prices by 5% year over year. But then for existing clients, you can say, okay, we're increasing prices by 10%, but for you, it's only 6% or 7%, because then it makes them actually feel like they're getting a deal in the process. The prices are still going up, but because they are existing clients, they feel like they're getting a deal. So how do you think like that has worked from that strategy? Because I've seen it work well. Like, how have you seen it?
I think that is, I call that hey, you're rewarding loyalty. For, hey, there are people who were with you before, they're continuing to do business with you, they still trust you. And I think it's also you as a business owner respecting the fact that, hey, depending on what it is that you do, them switching to a new product is a bit of a hurdle. Now, I've seen some companies tend to use it the other way. Once they're like, hey, we got you hooked, we're going to raise prices on everybody. It's almost like they give the better pricing to the new customer to get them hooked. But then all the existing customers like, oh, no, we're jacking up your prices. So, I mean, I do think I've seen some people do a little bit of both, but I do think that becomes a helpful way for you of just like we've done that a couple times ourselves, of where it's like, hey, for the clients that came on board before XYZ date, their pricing is this. And then for any new clients, hey, pricing is going to be X. Like, for example, at one point we did bookkeeping for, one point we did it for $400 a month. Yeah. And then we raised it up to $600 a month.
Yeah.
And then we raised now, new clients that come on board, they're starting at $800 a month. And I do think that for the clients who have been with us for a while, it's really like, hey, communicating to them like, hey, our prices are going up. Mm-hmm. And they're going from, $600 to $800 a month for bookkeeping. Mm-hmm. Because you are with us, we'll do a loyalty program of your price will only go to $650 a month or something mm-hmm. like that, to mm-hmm. where they start to understand like, hey, there's value here. Now, I will say the side that a lot of people don't talk about is when you start to do that, what I have seen some companies mess up on is if you got some legacy customers that are paying you $650 a month, you start giving more of your attention, your energy to the $800 a month clients and ignoring the $650 clients, when it's just like, okay, all right, you have to make sure that you don't fall into that trap.
Yeah. And the reality is you set the prices. So like the $650 was what the $650 was when you had those prices. So especially if you're saying, hey, I'm giving you a discount on this, quality of service should not change, right? Mm-hmm. And so that's actually a really good point, because I think it is easy. I mean, it's just like kids, like the new shiny object, like, mm-hmm. You're excited about it or whatever. And, you're like, oh, this is a new thing. And it's easy for you to kind of lose focus and not focus on the other clients that have been there mm-hmm. and have been loyal. But yeah, I think that's a good point.
But I think that's why, especially if you're a service-based business, even if you're a product-based business, like you have to get very clear on what people are getting for the price that they're paying. Mm-hmm. Because let's say for the people who are at $600 and you lay out, hey, here's what's included in your package at $600. For the people who are at $800, hey, here what's included in their package. And I think the more clarity you get on that, I think the better you can navigate it, because then you can start to understand if people are asking for more support mm-hmm. or they're asking for more engagement from you. Mm-hmm. If they're asking for more, then it completely justifies like, hey, that should be at a different price point. But I think you have to really break it down to understand, what is this customer getting for this price? Yeah. And then once I increase it, maybe there's something we can add to it. And maybe it's something we can add that's simple for us to do. But by adding this, it adds a little bit more value. So when they see that the price has gone up, they're like, yeah, my price has gone up, but I'm actually getting a little bit more. It won't be like, how some people feel about like their utility bill. Like it goes up, but I'm not getting anything extra.
I mean, that's how the electric bills are right now, especially like, we have a few family in the UK and they're getting astronomical price increases, and it's like, oh, inflation. And it's like, okay, so mm-hmm. Are you giving me more electricity or more usage? But no, I agree. Definitely
because
not good.
I think if you're in a situation where, let's say, you're a customer, if my price that I'm paying this company is going up mm-hmm. and I'm not getting anything different, I'll be honest with you, I am searching for the next best option.
That's true.
Because it's like, that is a great way to put me on the way out the door, is to continue raising my prices, but then not communicate what additional or incremental value am I getting. I'm like, if there is an alternative, then I'm going to jump on it, because a lot of cable companies ran into that. I mean, it's part of the reason why you see YouTube getting into YouTube TV, or Hulu getting into live TV, mm-hmm. or what Sling was one of the earlier ones that started getting into that. I mean, it was how satellite started breaking their way, or Dish Network or whatever started breaking their way in against the cable companies, because cable companies were raising their prices. And back when they had no competition, it wasn't a problem. Right. But then all these other options are on the table, to where it's just like, hey, as a cable company now, your product is a commodity. There are a ton of other places I can go to watch live sporting events or to watch live TV. So I don't have to keep putting up with you raising my price and not giving me anything extra.
Yeah, let me ask a question though on that before we finish up that point. But would you, I guess if I was a business owner, which I am, but in the position of asking the question is, so are you saying that every single time I increase my prices, I have to give some sort of value to incremental value to the client?
I believe that you should. Now, when I say incremental value, that isn't necessarily like, hey, you have to give them something new. Maybe you just improve the way that you're communicating the existing value to them.
Okay.
Because if you improve your communication channel, like that is value within itself. For example, for us, when it came down to some of the customers that were, some of the legacy customers we were doing bookkeeping for, they would, before what they were used to is they get a download from QuickBooks to get their financial statements.
Okay.
Now for the clients that are paying $800 a month, like we upgraded, there's a tool that we use to automatically download the information into a spreadsheet. They get direct, live feed access to that. So where it's just like, we're not really doing it. Actually, that new process we're doing is more efficient than the old one.
Right.
But to the person, they're able to get a live feed to it. Like that is incremental value to them. So we're not doing something completely different. We're actually helping ourselves by being more efficient using an automated tool. But to the client, that is more value.
Yeah.
So as they see that, like, hey, because when you explain it to your client as, hey, we're increasing pricing, not just because, hey, we just want to take more money for you. We're increasing pricing and, hey, here are some of the things that we're going to be doing moving forward. Because some of that is just natural evolution of technology or just natural evolution of the way you do things or whatever. And even let's say, for example, there was a laundry company where they come to your house, they pick up your laundry. Well, one of the things that I talked to them about when they were looking to increase their pricing is like, hey, maybe you guys get better quality bags, because for them to, put their dirty clothes in the bag, you come to their house, you pick it up. Well, if you have, bags that have a little bit more quality, to the client, that's value because they can see that, hey, this person is taking good care of my stuff or whatever. And so I think there are little things you can do to add more value that won't cost you much, but will help with that discussion when you're raising your prices.
That's fair. So just continually kind of, I think what you should be doing anyways, which is continually finding opportunities to add value to your client, right? Okay, that's fair. Yeah, I think that just sounded a little bit overwhelming.
Now, I will say, if it's going to be a significant increase in value, then maybe you price it out separately. Like, for example, some of our clients where some of them we started using, building custom dashboards for them to get their financial reporting. Like, okay, all right, that is a significant difference in what they were getting. Because let's say before you got a download from QuickBooks. Now you're getting this colorful dashboard with graphs and stuff. Like that's a completely different, that's not a value increase. That's a completely different product, which we price that separately. So, I mean, I think you do have to be, and I think that's part of being a business owner, is being able to understand your client and understand, hey, what would be small incremental value versus, hey, this is enough value to create a completely separate product or a completely separate add-on.
Yeah, no, that's good. So understanding the difference between both of those. Awesome. No, that's really good point. So I think if I was to summarize it, are there any other points you want to add before I do my little summary?
Yeah, I mean, I would say there was something I thought about back with the competitors. And I know you mentioned about like looking at other people's ads and stuff. And I mean, it's one of the things that we did when we were working with our marketing company to launch the Small Business CFO program. One of the questions the marketing company asked is like, hey, what are some of your competitors doing? And what I did is I went out there and you can go to the Facebook ad library. You can Google Facebook ad library. What that allows you to do is you can type in your competitor's name in a search box and it will pull up all the ads that they are currently running on Facebook. So you can see, hey, what ads are they using to attract other customers? And what pricing are they using on those ads? And I think that allows you to get an even deeper look into what's going on with your competitors. And I think also looking at, like, if you're a service-oriented business, a lot of service-oriented businesses are putting their prices on their website. If you're a product business, I mean, you can go to Amazon, you can go Google it or whatever. you can find out what your competitors are charging. Now, a lot of times your competitors may have a really big price on their website and maybe they offer some discounts, but it gives you a good idea on like, how can you realistically do a competitor analysis?
Okay, that's good. I agree. That's good insight as well. All right. So just from a bullet point standpoint, so if someone's like, all right, I'm doing it, I'm increasing prices. Well, one is we're saying you should increase prices. That's the baseline. But important things, understand your top sellers, or understand, you said pull a sales report by product. If you're using QuickBooks, or whatever tool you're using. Secondly, understand your competition, which is what you just explained. What is your competition doing? How are they navigating that? And then the third point, which I'm trying to remember, what was the third point we talked about?
I think the third point is where we talked about is being strategic about it.
Yes.
Is it may not necessarily be, increasing prices on everything at the same time, or it may not be increasing everybody's prices. Right. Maybe it's just, hey, here's the new price for anyone new that comes on. Here's the price for the legacy people. And I think just developing a strategy for increasing, because I think I've seen a lot of people just do it very sloppily, like, hey, we're just going to increase everybody's prices. And then you upset your existing customers who are loyal to you. And you scare away potentially new customers to where it's just like, you got to be strategic about it if you're going to be effective.
Yeah, and that's actually a good point. Reward loyalty, right? If customers are loyal to you, reward the loyalty, communicate promptly, let them know, explain to them why the prices are going up. Because I will say it's easier for me to absorb it. It may be BS from some of these companies, but it's a lot easier for me to absorb, we're increasing prices because prices are going up and we have to do what's best for our employees. And I'm like, all right, there, 5% it is, but I do think when people feel like they can understand and relate why, it makes it a lot easier, right?
Yep.
So definitely that.
And I would say one tip I would give it is, and this is the last tip, because we talked about this in the small business CFO Pro. So because someone was asking like, what if you can't afford to give discounts, to like your loyal customers? And I was like, well, one trick you can do or tip you can do is offer a special like referral program to your loyal customers to where like, hey, we have to increase our prices because of what's going on, but we really appreciate your loyalty. If you bring a referral, then we can reduce your price down from the new pricing, because that way the new person who comes on board, it helps finance their discount.
Yeah, that's good.
So, I mean, you can, like I said, you can be very strategic about it, but I think it just goes back to that point of like, you want to be smart about rewarding loyalty, because those people supported your business, they believed in you, and they're probably the most likely to bring other referrals because they already believe in your product and what you're doing.
Yeah, no, I agree. I think that's actually a really good point, is be strategic, be creative, and find opportunities to do that. So that's a really, really good point. So yes, awesome. We hope you guys enjoyed the discussion today. And now we're going to jump into our tax tea of the week.
Yeah, so I've been looking forward to this one. So.
Okay. How many of you, including us, have gotten calls, those automatic calls on a random Wednesday afternoon? You're in the middle of your work zone. This is me. This is how I usually work. I'm in my work mode. I'm working. I'm cranking out on work. Then I get a call. It's a number I don't recognize. And I usually don't pick those numbers up, but I decide to pick it up. And on the other line, I hear, have you recently purchased, is your Hyundai Elantra insured? Or if something was to happen to your vehicle, what would happen? Hold on while I collect, somebody basically trying to sell an auto warranty. I mean, all of us have had those. So the story today is actually about a gentleman who owned a auto warranty marketing company. So all they did was they sold warranties to to individuals, to consumers. And the funny thing about this is, it's not actually funny. All I'm going to say is they make a lot of money. Okay. These companies make a lot of money. But basically the story here is this gentleman owned a auto warranty company in 2014. I think that may have been the beginning or the early stages of his company. He basically had about $625,000 in profit, taxable income, did not file a tax return for his business. And in 2014, he also got paid $1 million from the company as an expense. They paid him a salary And what he ended up doing with that $1 million is, instead of depositing into his personal account, he deposited it into another account that was under another company's name, and was basically paying his personal expenses from that company's account. It was a completely different company that he had created. So paying his personal expenses from this account, his mortgage was being paid from that account.
Wow.
He was spending money from that account, but did not report that $1 million on his income. And this is where he got caught. Or this is my view of where I think he got caught, because it doesn't mention it. And it only mentions 2014 and 2015. But before I tell you how I think he got caught, let me talk about 2015. So for 2015, he filed his tax return for the business, okay? But he still did not include the $1 million in his personal income tax return that he got paid from the company. So he got paid $1 million in 2014, didn't include it in his personal taxes, got paid $1 million in 2015, didn't include it in his personal taxes, did the whole strategy of transferring money to the fake company name and spent money from there. This is where I think he got caught. You want to know what I think? I think because it talks about 2014, the business tax return, and 2015, the business, it doesn't mention the 2015 business tax return. I think he filed the 2015 tax return for the business. It showed as an expense line item of salary, of payments, or of owners, whatever, in equity or whatever it is, where like there was an expense reflected, I think, on the income statement related to that $1 million. And when they were doing the audit, they were like, you were paid, $1 million was paid out of this business to an employee of the business. But when we trace it back to who was paid for this, we find that the company actually belongs to the owner of the business. And we haven't seen him included in his tax returns. So I think that's how they caught him for 2015. That's my assessment. The point here is, now the punishment is, this is 36 months in prison, and 3 years in prison is what he gets, which I actually think was pretty light. But he's getting charged with basically tax evasion because he intentionally evaded paying taxes. And then he's getting charged for not filing a tax return for 2014.
Wow.
So those are the penalties, and that is the situation on this. So what are your thoughts?
You know, I think it is very interesting. And even as you were telling the story, like, some people may say, oh my gosh, like, you know, that's just outrageous.
Listen.
But I was right now, we're in Las Vegas right now. We're at the QuickBooks conference. And I was talking to some of my friends at the conference that all they do is they specialize in tax support. And one of the things we were talking about is like, there is a ton of advice being given on TikTok, on Facebook, on Instagram.
Yeah.
Some of it's on LinkedIn. That is bad tax advice. Even like going to some of these conferences, these people are giving these tax strategies. And as you were explaining it, I'm just like, oh my gosh, we were talking about that last night, because like one of the things that people talk about sometimes is like, oh, here's how you can get, you know, your business to pay for your house and it be tax free. You set up this type of entity, and then you get the business to pay this entity, and then you can pay your mortgage through this one because you can put the business. And it's like, I've heard people explain this tax strategy.
That's right.
And then we were just talking about, like, in knowing it, like as CPAs, we look through and we can tell, like, okay, there's your gap. That's if you do it the way they described it,
right,
like without the very, very, very qualified people who can actually really know what they're doing and make sure all the T's are crossed, all the I's are dotted,
right,
like you're going to end up in a tax evasion issue. Like this guy, like someone should have told them, like, hey, this is going to draw a red flag. Now, when you talked about like the payrolls, like when you were, and this is something I think a lot of business owners don't understand. It's like when you actually submit your tax return, let's say you say, hey, we paid these employees.
Mm-hmm.
Now, if you've been filing, you know, your payroll taxes, you have to file a form 941.
Mm-hmm.
So then what all the IRS has to do is go find the 941 that is attached to this business's EIN number.
Right.
Does the number on those 941s match the number that's in their tax return? Yeah. And that one can be just programmed into the system.
Right.
And then if it doesn't match, it's going to pop up as a red flag.
Yeah.
Because I'm pretty sure that guy didn't report the $1 million on on his 941 as payroll income.
Yes.
So he didn't pay payroll taxes on it.
Yes. So that's another thing they charged him for, falsifying tax documents. Because I think what he did is, I don't know, maybe he categorized the $1 million as something else, like as another type of expense. So he didn't have to pay payroll taxes on it, and then excluded it from the 941. That's a potential. But no, I mean, I was just like, that's actually, now that you mentioned it, I'm like, yeah, I've seen a lot of content on social media lately where people are like, yeah, you can have your business pay for your house, you can have your business pay for your car and all that stuff. And I'm like, guys, if you are not using this stuff for the business, this is already like immediately a red flag. And the whole using it for the business, there are rules against that go towards what using something for the business actually means. If you are vacationing there one month out of a year, that is not a business property, right? So it's just like being able to really understand, like, are you truly covered within some of these advices that you're being given? And I think really more importantly, I think another thing to pay attention to that I was thinking about is that 2014 period, because he didn't get charged for anything else. It was just 2014. And 2014, and then the 2015, of course, the personal income thing. But for 2014, one of the things that I thought about as I was reading that was like, he probably didn't think that the IRS knew he existed. My thought was maybe he started this business in 2014 because it seems like he did everything else correctly. Maybe he started the business in 2014. He's like, yeah, we're just getting started. I'll pay taxes later, and just never did it. But the other thing you have to realize is when you register your business, when you get the EIN number, the tax ID number, whatever it is for your company, like, the government knows you exist. Like, you are a business now. So they can probably go back and look and say, okay, his business started, this is an example. His business started in 2013. You want to tell me he had no taxable income in 2014? Because I think he had no taxable income. He didn't file a tax return. Like, that doesn't sound shady to you? So like, I think those kind of things it's important to be able to connect the dots and realize that the dots are always connected. And then I think specifically for even like, how could an accountant have prevented this? The person that did his taxes, because it doesn't mention if he did it himself or if there was someone else managing that. But it's just like, if you're doing both the personal tax return and the business tax return for this person, you need to kind of be able to correlate and say, okay, these expenses were related to this person's personal finances. Are they reflected in this tax return? Is what this person is telling me actually aligned with what the business is doing? And I think that's why it's so important to work with the right person, because if it was me, I would have been like, there's no way you're going to get away with this. Right. And be like, okay, please go to somebody else because I'm not going to be affiliated with this kind of behavior. But I mean, that is something a good tax accountant should have been able to cross-reference and tell him, hey, you're not going to get away with this. And it sounds like it was done correctly. So maybe he got an accountant after that. But just also understanding that there's a 7-year period, right, where the IRS
I believe it. I mean, because like you said, this happened in 2014. At the time this case was decided, it was what,
2021. So it was right at the edge of that 7-year grace or 7-year period where they can go back and audit stuff. So can you imagine, like, thinking you got away with something and people being like, well, oops, no, you didn't. You did not pay tax.
The other interesting thing is, because the 36 month is that's just the case that happened at the federal level.
That's true.
That doesn't include the state, the state
the
level,
local,
or depending on what state he lives in. Maybe there's a county and a city level taxes that are involved to where, like, if this guy was, supposedly this $1 million was payroll, usually you have to pay federal taxes, you have to pay state or local taxes on payroll and stuff, to where, like, 36 months may be the federal penalty he got, but there may be even more penalties that come at the state level, to where I'm just like, it does not pay to have sloppy tax strategy. And I know a lot of people are like, I just don't want to pay taxes. I'm just like, well, you want to make sure that you don't do it in a sloppy way, or that, you find yourself in this guy's situation, because he probably heard some tax advice from someone of how you can set up an entity and you can do this. Like I said, for a lot of people who are just like, hey, I write off all my vacations on my taxes. And one of the critical things about it, because like I said, I was talking to some of the guys last night as we were talking about this, is one of the very key things that IRS really put in the language was, one of the, I guess you say, the litmus test is this a ordinary and necessary expense related to your business?
Necessary is subjective.
It is subjective, but when it just becomes very obvious that, hey,
you don't really need
the nature of this business does not require to pay for your mortgage.
You don't need a penthouse house in Colombia as part of your business that's based in Tennessee. Like, what are you doing? What are you doing with a $500,000 penthouse or whatever in Colombia, in Medellin, Colombia? Like, you don't need that. So that's definitely not necessary. But I think at the end of the day, I think that's why it's so important, because it is really not the hassle. It's not worth the hassle to have to go through these processes. Just do things right and do it right the first time. And it's different if you make a mistake and like you have you've taken actions to correct it, because he could have very well, if he actually filed and went with an accountant in 2015 and he truly was, trying to do things better, he could have just been like, hey, can you take a look at my 2014 tax returns, or had him file this? Is this going to be a problem? Like, if he asked an accountant, a tax accountant, someone would probably be like, yeah, you probably want to go ahead and pay taxes on that, because
he could have gotten on a payment plan.
Exactly.
We could have corrected it with the IRS and just like, hey, we know that we made this issue. Let's get on a payment plan and let's pay it down over time. And that way, because I do think is when you find yourself in a situation like that, if you've been guilty of a tax related crime, it does put limitations on other types of businesses that you can start after it, or it puts limitations on the type of financing you can apply for. Let's say if he comes out, 36 months from now, he wants to start a new business and he wants to go to the bank and apply for a loan. If that pops up in the bank's check that you've gone to jail for tax evasion and tax fraud, like the bank, that may look negatively against you, and that guy may not get the loan. So, I mean, I'm just like, there's so many ramifications of it. I mean, we can talk for days about this, but yeah, so those are my general thoughts on that one.
Yeah, no, I don't have any other thoughts. I think that was one of the ones where I was just like, man, it resonated with me because of that warranty call. And I was like, man, this dude he probably made over 30 million. For you to pay yourself $1 million salary, he was making probably, I think they said $30 million a year.
Oh, wow.
I mean, from auto warranty calls.
Wow.
So somebody's picking up.
That was probably his revenue number. So he probably didn't keep all of it, but still $30
million in revenue from you calling and disturbing people every 5 minutes. Like, oh, do you have an auto warranty for your car? I'm like, I don't need an auto warranty. At least once, maybe 3 times a week, I get a call on that. And then, so I'm like, listen, that's money right there. Okay. $30 million.
Well, thank you guys so much for tuning in. Until next time.